Welcome to the Daily Update. This is Being Prepared Monday, May 23rd, where we'll look at the action in the market today and then see how things look for Tuesday, May 24th. And we saw a nice rebound. And if we are going to continue and possibly see some kind of an extended bounce out of this, what we saw on Monday, carried over from Friday, is what we needed to see. We're not seeing an awful lot of confirmation in our charts, but some of our possible positive scenarios are looking better, and I'll show you those charts and go through things. So let's go back and talk about what happened on Monday. Right at the open, we did have a gap higher open, and during the night, the futures had been fairly positive. We didn't have any economic reports to push things one way or the other, and the market decided it wanted to go higher, so it just gapped at the open, and then we saw a nice rebound after that. Prices did advance to above R1. Now, R1 was at 39.60. We went higher than that, but I just wanted to point out what that resistance level was. As the day went on, prices fell below R1, and then they rebounded again and went back to the daily high and actually set a little bit higher high for the day later in the day. Going into the close, we saw some late day selling, but prices closed near the high for the day. So overall, it was pretty positive, but we're kind of left hanging right now. Is this going to continue? At the time I started recording this, the futures are down about 1%. Is that going to carry over into the session on Tuesday? We don't know right now. We ended up being up 1.85% for Monday's session. Volume was below average. That's another warning sign. A lot of people just don't trust this. If they even think about what happened on Friday and the carryover into Monday, they see this as little more than a dead cat bounce right now, which could work to our advantage if we're watching other things. If you remember back in mid-March, it looked like we were just coming up with a dead cat bounce. Well, that turned into a really nice gain that ended up lasting a few weeks. Is that what's getting set up this time? We can only ask that question right now, look at the charts, and then come to a conclusion after that. The technicals are still negative overall. There's no doubt about that, but we were very oversold. We saw the rebound on Friday. It carried over into Monday. If things are going to get better, this is a start. Inflation and interest rates, as well as growth concerns, are what the market's really fixated on right now. Of course, all the different geopolitical events and earnings as they're coming out. What are some comments that we can make? Friday's late day rebound continued on Monday. So if we were going to see some kind of a bounce, that's what we needed to see. Was this an oversold bounce, or are we starting a reversal? The VIX is still producing some information, and I have a chart that I'll show you on that. The 10 to the 5 yield curve still remains inverted. Again, nobody's really talking about this. I just happen to notice this on the chart. But it's not normal for that to happen. One of the news events that's coming out as the president is in Asia right now is that some of the tariffs that have been placed on China may be lifted. And that seemed to kind of help things a bit. Fear is still very extreme. We're still in correction territory. We're not in bear market territory. That's at 20%. But we're still seeing a significant correction since the all-time highs back in January, which seems so long ago now. Economic reports, there weren't any that came out. Our trend, it's still negative and getting stronger, even with the up day. The ADX continued to advance. The bias, I've switched over from being mixed to slightly positive, but now we're going to have to see what's going to happen on Tuesday. We could lose this bias really quick. The momentum, I'm switching back over to mixed because some of our intermediate term charts are showing some improvement, but we're still negative overall, and we could lose that quickly. Let's go back and look at the day's session. First, we'll look at sentiment. Here is fear, where we did bounce up a little bit, but we're still in extreme fear territory at 14. And if you look over on the right-hand side, and I'm trying to use a different pointer now, you can see where we have spent a lot of time below 25. We've just been camped out at this level for a long time. As far as the VIX, with the up day, on a closing basis, the VIX did decline. And looking at the bar chart, we closed pretty much at the bottom of the bar on the VIX. So we're seeing some improvement. However, these are still pretty high readings. We're still into the 20s, and we're still above the moving averages on the VIX, both on the line chart and on the bar chart. This is the chart that I'm trying to look at and see if anything interesting can be gleaned from this. In the last video, I didn't tell you what this top part is. This is not the VIX. This is a moving average of the VIX. Kind of smooths it out a little bit to give us a little better idea of what's happening. Down below is the S&P 500, and I haven't added a lot of labels on this because I'm just trying to decide, is this chart even useful or not? But it's acting strange. We're way over on the right-hand side in the middle. We are seeing this really spike up. And other times when we've seen a real spike in this, we try to determine what happened after that with the market. Sometimes we saw a decline, sometimes we saw a bit of an advance, but it did produce some kind of movement after that, either positive or negative. But what I'm waiting to see is, number one, will this continue to spike up? And then number two, what are the market conditions at that time? Also looking at the Ulcer Index, it shows that fear is still increasing, even with the bounce. And here's a longer term chart, and we're getting pretty extreme. This is the highest we've been since the COVID plunge. Also, the equity put-call ratio, because we had an up day, it really fell on a one-day basis. It's still kind of high, but it's well off of where it had been before. The 5-period simple moving average of the equity put-call ratio, it did decline a little bit on Monday. Here's another chart that's just showing tech flows. When we're seeing the blue line above this flat black line, that means money's going into tech stocks. When we see it below this black line, that means that there's outflows or money's coming out of tech stocks. And right now, we are below the black line, and they also plot a 4-week moving average on this as well. So just know that overall right now, we can really only look at what's happening right now. We are seeing money flowing out of tech stocks, which is not a real surprise since the tech sector has been really weak so far in 2022. Another chart shows the blue line, which is the S&P 500, and then the orange line here is the ISM Manufacturing PMI. And it just compares how this PMI has acted over a period of time and how it tends to really correlate with the S&P 500. It has been declining, and of course, the S&P has also been declining. Another thing is valuation. Looking back on the 90-day change in the forward PE, and if you watch the weekend video, I had a chart where I talk about trailing 12 months. That's looking back. That has some useful purposes for us. But the stock market looks forward with what we call a forward PE. And this is based on forecasts and optimism and what the company thinks will happen going forward. That's all what investors listen to, and that's put into the stock price. Looking at this, it just says over the past 90 days, we've seen the sharpest contraction in the S&P 500's forward PE of the past 15 years. This was in the financial crisis back in 2007 into 2008. We also had this reading very low during the COVID plunge. We're also seeing that reading right now. So this could be positive for the markets. The next chart, put out by Goldman Sachs, it just says that sentiment is very negative, which we can use in a contrary manner. And since we're very, very low at 2.4 right now, that lining up with some of our other indications show that we are extreme negative, and when we get to that point, that could be positive. The next chart just takes a number of different measurements and puts them together as a composite, and it's showing that we're getting down into extreme fear. I talked about this in the weekly video, and since some of you may not have seen that, I wanted to go ahead and quickly go over it here. The currentmarketvaluation.com site or model is now telling us that we are fairly valued. And looking over on the left, the yield curve is still fairly valued. The Buffett indicator is also fairly valued after being really extreme for quite a while and coming down. The PE ratio is still extreme, so that's considered to be overvalued, even though it was a lot higher. Interest rates are also fairly valued because even though they're going up, they're still historically low. The margin debt as of the end of April has been declining, so that's fairly valued. And the mean reversion, which is the one that I probably pay attention to the most, how far are we getting away from the mean price? We had gotten far away from that when we set the highs. We've been coming back down, but we're still overvalued overall. Let's go through the sectors. The financial sector had a really good day. They've been seeing some real weakness lately. Well, they were up 3.25%. Energy up 2.64%. Tech 2.3%. Staples are up a little over 2%. And they've been getting hit hard, especially last week. So there was a bit of a rebound in the staples sector. All of the sectors ended up being positive. The one kind of slow moving one was discretionary, and it was up, but only 0.75%. And here just shows you energy has been doing well, followed by utilities. The rest of these as independent sectors have been underperforming. Technical alerts, not very many of them, but they were positive. The NASDAQ was able to get above 11.4 and then eventually 11.5. The NYSE BPI crossed above 30, so that's positive. The financial sector, which had been having some trouble, it crossed above 20 with the BPI. Let's go and look at the intraday chart. Way over on the right-hand side, it shows where we did gap up at the open. We did see some initial selling because that's what happens quite a bit. If you gap one way, you'll see a counter move that may turn into the trend for that day. Well, that didn't happen on Monday. A little bit of selling, but then the buyers came back in, took us above R1, and it looked like, okay, this is looking pretty good. Where we did fall back a little bit to below R1, but we were able to bounce back up. We set a little bit of a new high right here. Saw some selling going into the close, but then a little bit of buying as well, and we closed just about at the high for the day. Looking at our daily chart, right here where I have this highlighted is where we're at right now. We were able to bounce up off of S2 on Friday. Well, right now, we closed right at S1. Do you think these lines are important? The thing now that we're going to watch is, can we get above S1, or is this going to be resistance, which it is right now, and we'll see prices decline from here? That's the question that we're looking at. And I extended this chart a little bit, and it kind of looks even worse. Mostly what we're focused on is way up here in the corner, and there's lots of scary lines. But I wanted to go back all the way to the COVID low and mark a fib level at that point, which goes up to the all-time high. And then there was a significant low that we set back in 2020 all the way to the all-time high. And some of these overlap, which is very interesting. That's why I wanted to show this chart. We see over here on the right-hand side where, yeah, we've been retracing, but we were able to bounce off of this level, which are two fib levels right here, and then come back up and show at least a little bit of improvement for right now. Looking down on the bottom, we see that volume was below average. We're down 17.15% from the all-time high. Technical overview, no changes here, even with the positive day. We're going to have to see an extended move one way or the other for things to really change. So we have energy, commodities, gold, interest rates, and staples. Even though they had a rough week last week, they're still outperforming overall. The negative things, and I'll just click off the list as we go along here because this has not changed. Looking at our trend, way over here, we see that the red line is still above the moving average, so I'm still calling that strengthening, even though it flattened out slightly, but it did advance. We saw a decrease in selling pressure and an increase in buying pressure on Monday. Looking at the Arun, a little bit of a decrease with selling pressure, but also a bit of a decrease in buying power. So overall, our oscillator is going sideways, but it's negative because we are below zero. Looking at breadth, it had a pretty good day based on price and volume. So our advanced decline line based on price is improving, but we're still under the moving average. We're seeing the same thing with volume. We did advance slightly, but we're below the moving average, and the moving average is declining, where with price, the moving average is still ever so slightly going higher. The 10-day average of the highs and lows, we had been really extreme. We saw a little bit more of a rebound on Monday, so it's still fairly extreme, and this could be another catalyst that helps the rebound turn into more of a significant move. Advanced decline ratio, we're trying to get back above 0 right now, so that is slightly positive. New highs and new lows, after it got whipsawed a little bit, it's trying to turn back up overall, and our 10-day moving average also turned up on Monday. So just little pockets of positive signs, but we could lose that with a strong down day. Accumulation distribution, a little bit of an advance because we're above the moving average, but the moving average is still declining. Short term, McClellan oscillator is above 0 and advancing. Force index, I circled it right in here because to see where this indicator closed can be kind of difficult. It did show some improvement from Friday. Williams percent R is above the 0.5 line, which is the midpoint. When we get above that, that is positive. But this is a pretty short-term indicator, and it can really overreact. Williams percent R is also bouncing up after giving an extreme negative reading. Ultimate oscillator crossed above 50, so that's positive, where it was right below 50 after Friday. 20-period moving average study, we're showing a nice little bounce after being extreme negative. The 50 is trying to turn up. The 200 is also trying to turn up. Stochastics, looking better on a short-term basis. Still extreme, but bouncing in intermediate term and still floundering around to somewhat positive with the long term, but we are still giving an overall extreme negative reading. Intermediate term, rate of change, trying to come out of giving us an extreme negative reading. Momentum oscillators. The slope is positive and has been for a couple of days now. The MACD is trying to turn higher. The KST is rolling over a little bit, but still negative, as is the TRIX and the PMO, where the TSI, it's trying to turn up slightly as well. Vortex, seeing a bit of a decrease in selling, a little bit of an increase on buying, but with the red line on top, we are negative overall. Sean trend meter turned up slightly, but still giving us an extreme negative reading. Swinland trading oscillator had a nice little bounce based on price and is above 0, and we're just slightly negative based on volume. The BPI still has not come back above 30. If we have some kind of an up day on Tuesday, it's very likely that this will also generate another technical alert. The PMO turning up a little bit, but it has a long way to go to turn back positive. But looking at price and volume, they are starting to turn positive. The PMOs that are rising is showing much improvement. The buy signals also showing some improvement. Those that are above 0 is pretty much flat to negative. Summation index turning up based on price slightly and turning up based on volume. Boom indicator, and I put arrows in here to make it a little easier to see. We are still extreme negative. This is how far away are we from the 20-period moving average. Down here, this is how far away are we from the 200-period moving average, and it's not necessarily extreme. Chaikin oscillator crossed above the dashed line, so that is turning more positive. Ease of movement showed a bit of improvement. Chaikin money flow is still negative and actually ticked down a little bit, but overall the moving average is showing some improvement. This is an indicator that I don't really show all that often, and I kind of have to explain it a little bit. This doesn't measure price. This measures volume and then the intensity of volume. When this is going up, that means volume's pretty intense. When this is going down, that means volume is really dropping off. And that's what we're seeing right now. If you look back to the middle of March, when we had that nice little bounce, we spiked up a little bit, but this is why that bounce ended up fizzling out, because we saw a decrease in the intensity of volume at that point. And it's really volume that drives things either up or down. So when this line is going up, we're seeing more conviction. When this line is going down, there's less conviction or fear or they're not trusting what's actually happening. Another indicator that I don't show that much, we're pretty much neutral on this. This just shows a 19-day EMA of the advanced decline line ratio for the S&P, and we're more in the midpoint, but we just crossed over to be slightly positive. TTM squeeze showing some improvement. Looking at it as more like an oscillator, still coming off an extreme negative reading. The different charts, the Heiken Ashi showing a little bit of improvement here. We have an open candle, and that's positive. However, the Keiki chart is still negative, and the Renko chart is still negative. 3-line break actually put in a clear candle. Now, if we have a down day, this will all redraw and look a whole different. We can only go with what it looks like right now. Different trading systems. The Elder's Impulse system is still neutral for the S&P, as it is for the SPY. The Parabolic SAR continues to be negative. The Go, No-Go system is still dark purple, even with the advance, so we're still negative there. We're well below the 200-day simple moving average. Our longer-term moving average study, trying to bounce up after giving a really extreme negative reading again. And you can't even say there's a divergence here, because you can see when we hit this low, that was at 76. When we hit the even lower low, we were at 71, which that's negative as the numbers go down. So there's not even a real positive divergence right here. So that could be a little bit of a concern. On the 150, trying to show some improvement as well as on the 200. Special K continues to decline overall. Here's this crazy fib chart that I came up with, measuring from the COVID low to the all-time high, as well as the 2020 low, which is kind of like the daily chart that I was showing you, where I couldn't really draw these lines over because I want there to be a difference in color right here. But we came up off of this 38.2% retracement as well as a 61.8% retracement, which were pretty much right on top of each other. That could be positive. Now, if we end up going higher, this 50% level could act as resistance. Looking at some broad market indications, the diamonds are neutral and the Qs remain neutral. The Vixen declined with the up day, both looking at the chart and closed near the low of the bar. And on the line chart, it also showed a decline. Looking at our Amex, NASDAQ, NYSE 5-period high-low average, we're showing some improvement, but we're still below zero overall. Other broad market indicators. Dollar just got hammered, down over 1%. And this is what we're looking for. We're trying to see over here, did the dollar spike like it did other times? This is where it's kind of at right now, even though it's declined a little bit since this chart is now a few days old. But during the COVID plunge, right before that, we spiked up. During the Trump Brexit surprises that hit the market, we spiked up only to go down. And then when China devalued their currency, it spiked up to 100 and then fell down. Is that going to produce weakness in the dollar? Now, if we do see some weakness in the dollar, it may really suck if you live overseas or if you want to do some traveling, but usually a declining dollar can help push the stock market higher. It doesn't want the currency to completely fall apart, but it makes their accounting look better. It makes their imports and exports easier if the dollar is in decline. Oil is at 110.29, where it was pretty much unchanged on Monday. The gold futures were up slightly, about 1/3%. We're just trying to get back above the moving average on the futures chart, and we did get above the moving average and stay above it on the ETF chart, even though this is a little bit concerning. We opened, made a high, came down, and actually closed lower than the open. So even though we were up 0.47%, this bar is not necessarily positive. And here's a longer term look at the same chart. Silver, kind of the same thing. It closed and then closed lower than the open, even though it was up 0.15% on the day, and we're in danger of seeing a death cross. Here's a longer term look at that same ETF. Bitcoin has been trying to decide above 30, below 30. And I just bring this up to show some different head and shoulders patterns. And then there's head and shoulders inside of head and shoulders. Right now, this is a real line in the sand. Anybody who's in an online chat room and talks about this, of course, they know exactly what's going to happen. Well, I don't. And the whole world doesn't. You can be as dogmatic as you want to say we're going to bounce from here, we're going to crater from here, but nobody really knows overall. Looking at bonds, saw a little bit of a bounce. And this is another thing that we want to watch for. If bond prices really start to pick up and go higher, that will help interest rates to come down. Are we wearing off this extreme negative and extreme oversold condition? That's the question we're asking. We want to see follow through if that's possible. I wanted to bring this up again just because the 10 to the 2 continues to be inverted. And here's an isolated look. Treasury yields pretty much across the board went up. Internationally, a little bit of a tick up across the board as well. And as I keep saying, we're watching the red line, Japan, but it's kind of been really chopping sideways. The yen bounced a little bit, as did the euro. The dollar declining. We're trying to now figure out, was this a spike before the dollar gets set to go lower? And here's the euro against the dollar. The euro's at 106.9, where the dollar's at 102.1. So they're getting further apart now. This is the other interesting phenomenon that we've been seeing the last week to week and a half, is that typically interest rates up, stocks down. Well, we've been seeing the exact opposite of that. The relationship between them going in the same direction still remains quite high. It'll never get to 1. That means they go step by step with each other. Just like -1 just means they go exactly in the opposite direction. Well, this is still pretty high overall. And then just to show you the corporate bond yields right now, I don't have any corporate bond charts, but I just wanted to show you the yield. On the AAA bonds, we're at 4.11%. With the BBB bonds, we're at 5.14. A little higher return, but not as good a quality. Our possible positive scenarios. We are seeing some changes here. The Kopit curve is turning up, and it's crossed above the red line. That could signal something, but we don't necessarily want to use this in isolation. We've been faked out before. Back in January, we saw a really nice cross right here, and then look what happened. We fizzled out really quick with the S&P. Then we saw a cross again in the middle of March, and that's when we saw a really nice run-up after that. What are we going to see here? If we go down, we're going to lose this signal. But if we continue to go up, then we'll be able to see more of what this indicator is doing. The 2-year Treasury yield, well, Treasury yields were up, so we don't know if we spiked yet or not. The mass index has not generated a signal yet. Bottom Fisher, this is trying to cross right now. And again, we can't use this in isolation. Sometimes this gives us a really good signal. Other times it fakes us out. But it gave us a pretty good signal back in about the middle of March. And it lined up with some other signals that we're getting. And that's what we're trying to watch for here. Are we seeing some of these things come together at the same time? This is not giving us an indication. After Friday's session, I said there looked like a little spike up here. Well, we ended up being down 0.63% with the ratio. So this is not necessarily spiking. We want to see this go up a little bit, and then a few days after that, see if the S&P spikes up as well. But that's not happening. This is probably the most viable look right now. Even though staples were up a little bit, we're seeing a real decline in the overall ratio. And again, when this has spiked and then come down, this has often marked the bottom within the S&P 500. And right now, it looks like that could be happening. But we're going to need to see follow through with price in the S&P. So what's our outlook for Tuesday? The technicals, they're negative, but they're bouncing from being oversold. And the big question is, can the rebound continue? Sentiment remains extreme negative. Growth against value, the battle goes back and forth. Economic reports, we do have the preliminary IHS market manufacturing and service PMIs, as well as new home sales coming out on Tuesday. Looking at the geopolitical events, of course, we have Russia, Ukraine, China and the supply chain issues. It's my understanding that they're lessening the lockdowns in China, which could help their economy, which could help them sell us more stuff, which might help our economy. Inflation, interest rates, and growth concerns are the real fixation of the market. We want to keep an eye on oil, earnings on an as-released basis, Fed speak that may come out. We do have the FOMC meeting minutes coming out on Wednesday. That could really drive the markets if they read something hidden in the notes. And then Japan, the longer-term scenario that we've been watching. So our scenario is we are still headed down overall. And that's being caused by rising interest rates, inflation fears, growth concerns, earnings, Fed speak, and fear. Any one of those can drive things lower. And the technicals are showing that we are still negative. I switched this up a little bit. So what can we look at to see if the market will end up going higher? The technicals are negative, but improving from oversold readings. Sentiment is extreme negative, which we use that in a contrary manner. And we saw follow through from Friday's rebound. Can that continue on Tuesday? The possible positive scenarios. The Copic curve is turning up. The praying bottom fissure may soon cross. And it actually looks like it might be crossing now. And the Staples spike is looking viable right now. That something might be happening there. Technicals, pivot points, fib levels that I don't have on here. Previous levels may provide either support or resistance. And we're not in a sideways trend right now, because the ADX is above 20 and showing the negative trend. So our conclusion is the S&P is still negative. Short term, negative, but bouncing from being oversold. Intermediate term, it's still negative, but it may be improving. Long term, we're still negative overall. So thank you. I hope you have a wonderful Tuesday, and I'll prepare the next video after Wednesday's session. One of the things that you may notice is I'm running the videos a little bit longer because when I upload this, especially to YouTube, I have those end cards that are supposed to help people find my videos, and YouTube is supposed to like that. And so I add those, but it ends up covering some of the information that I presented earlier. So that's why I'm running the video about an extra 30 to 40 seconds after I finish talking to get those things out of the way and to hopefully make YouTube happy at the same time.